So we're here at Super Return US East, and I'm with Bob McNally, and you're founder and president of Rapidan Energy Group.
Right.
Thank you for joining us.
It's great to be here, Phil. Thank you.
So we're going to talk oil today. So at a high level, broadly speaking, how would you characterize today's global oil market?
Well, Phil, I would say for the first time in sort of 90 years, we're back to real boom-bust price cycles. The quintupling of oil prices from 03 to 08, from 30 to almost $150 a barrel. The collapse in 2014 from $100 to $45 a barrel and then down to 26 in 2016. That is not your usual oil price volatility. We haven't seen moves like that, and not just in their size, but their cause, since the 1930s. And what it tells us is, and what it reflects, is for the first time in about 90 years, we haven't had an effective swing producer, a market balancing oil supplier that has the role of stabilizing oil prices, preventing those kind of swings by quickly increasing or decreasing production. And OPEC used to do that, and before OPEC, we did, the United States, the Texas Railroad Commission, other states, but we should ask ourselves, and you know, this is a great conference, and we're talking a lot with private equity investors, and but no matter how you're exposed to the energy and oil markets, I think one question really has to be answered: what accounts for this extraordinary volatility in oil prices, unusual in modern times?
Okay. So let's talk about the US specifically.
Yeah.
So this country is now the world's largest oil producer, on track to perhaps become the largest exporter in not too long a time. So what's your near and longer term outlook for US oil, and more specifically, can US shale oil play that swing producing, price stabilizing role that you emphasize in your presentation and recent book are essential for the markets, for market stability and a positive investment outlook for the industry?
Well, our outlook near term for the U.S. is very positive. You never should bet against the U.S. oil industry. And I think we're going to grow our crude oil by 1.5 million barrels a day, add on NGLs, and you're going to be closer to 2 million barrels a day, I think, in total liquids growth every year. That should accelerate later this year when we debottleneck some of the Permian production. Eventually it's going to slow down. But I think we're going to be surprised at to the upside in the near term. So we're very optimistic on production growth. You know, one of the biggest challenges to U.S. crude production really comes from the crude quality side. The real question, I think, is going to be, at some point, will the world refining system sort of kind of have enough of what is lighter crude, higher API crude. So there's this crude quality issue that is something the shale industry is going to have to deal with. But even then, I think market focuses will equilibrate. We will learn to love the gasoline and naphtha that shale oil produces, and I think all will be good in the long run. But I'm very optimistic on U.S. shale oil production. With regard to the second thing, and that's in a way the more important question: can shale be the swing producer? I think the jury was out and the jury's back. We've been asking that question since 2014, and the verdict is no, it cannot. Shale oil did not prevent oil from falling to $26 a barrel in February of 2016. What stopped prices there was not shale oil. It was the Russians crying uncle and going to the Saudis and saying, okay, we've had enough pain. We're willing to now join with you in managing this market by contributing cuts. They've only done small little cuts, but they've gotten the Saudis to resume that role of swing producer. Shale oil doesn't move fast enough. It's more flexible than conventional oil production. It doesn't take years to come on, and it declines very rapidly, as we know, at the well. But in terms of being able to cycle up and cycle down in a matter of weeks, and with the purpose of keeping oil prices stable by avoiding imbalances in inventories, either big inventory draws or builds, shale oil can't do that. There's too many producers, each of them with their idiosyncratic profiles and funding and so forth. And you know what? Even if they could, it would be illegal. We don't allow companies to collaborate for the purposes of controlling prices. We made that illegal under the Sherman Antitrust Act. So shale oil isn't going to play that market stabilizing role, which means, in some ways, shale oil depends on Russia and Saudi Arabia, which had formed a kind of a new marriage. And they're trying to hold it together and keep a floor under oil prices. And to a large extent, shale oil requires that marriage to be successful.
Okay. In a recent Axios article, you stated, quote, "The oil market has rarely seen so much two-way risk," unquote, and mentioning China as among the drivers of oil price volatility. Can you talk us through how the US-China trade war, as well as the state of the Chinese economy, might impact oil into 2020 and beyond?
Sure. You know, I've been counting barrels for 28 years, and rarely have I seen an oil market where I could make as good an argument for $15 a barrel higher as I could for $15 a barrel lower. And over the last few weeks, we've moved in the lower direction, and that's because of this trade war. You know, one thing that causes oil demand to fall very quickly is when growth slows down, a recession, right? Demand doesn't really respond much to prices. The price can go up, you and I are still going to buy gasoline. But when we're thrown out of work, our demand, our need to travel to work goes down the next day. And so the big fear in the market, and we've had a long time since we've had a recession. Economists would say we're due for one, we're overdue for one. And with a trade war growing with China and the real tariffs going into place, restrictions really happening, signs from China and the rest of the world that demand, economic activity is slowing down. This is like the bubonic plague for the global oil market, and because it could kill demand very fast. So most barrel counters now would assume that, assuming we're growing in the mid 3% globally, GDP-wise, we should have about 1.3 million barrels a day of demand growth, which is what we've seen in recent years. But if we're going to slow down, if GDP is going to be in the 2 or 1% range, if China, the largest source of demand growth, is going to see its GDP growth collapse, I mean, it could be closer to several 100,000 barrels a day or just flat. And in a world in which we're growing our liquids, as we just discussed, 2 million barrels a day plus, 2 million in just the United States and elsewhere, if you have all that supply colliding into a collapsing demand because of weakened economic growth, and it'll happen very fast, the price of oil could collapse.
Okay. So obviously China is not the only region that could present issues for the global oil industry. In that same Axios article, you mentioned intensifying geopolitical disruption risks in the Middle East and Venezuela.
Right.
What are the implications of these developments for the global oil market?
Yeah, and here's where the $15 could go higher. You know, at the end of last year, Brent topped out at $86 a barrel, and everyone thought it was going to 100. Why? Because President Trump was promising to sort of get rid of all Iran's oil exports. And at that time, we had very tight spare production capacity, and the market was concerned that with a geopolitical risk situation that was already very concerning, you have disruptions in Libya, disruptions in Venezuela, which have since gotten worse, that with only a small sliver of spare production capacity, driving Iran's oil exports out, provoking that country, wouldn't leave us with a safety buffer. One other little disruption and the price of oil would soar. So it's only when President Trump in November issued waivers and sort of eased up on Iran that everyone relaxed a little bit. So the market's in a little better position now. The Saudis have cut production, so we have a little bit more spare capacity. But still, Venezuela is imploding fast as we tighten sanctions in that country. And Iran's exports now have been driven down to close to zero, about 500,000 barrels a day or less. Mr. Haftar is moving on Tripoli in Libya, which threatens another couple 100,000 barrels a day from the Zawiya terminal. So we're back to a situation sort of like last year, where we have a lot of hot geopolitical risk, it's intensifying, and we only have a little bit of a spare production capacity buffer. And you know, this gets back to having an effective swing producer. A swing producer will typically hold back production off the market. Now, he's doing that mainly to keep oil prices stable. But a side benefit is he's got a little bit extra there, hopefully a lot extra, so that if there's a disruption or a war, you can bring it on quickly. And if investors see this, they're comforted and they're relaxed and they're calm. With spare being very thin, there's not a lot of margin for error. So we've fallen $10, $15 a barrel in the last couple of weeks. We could go right back up if there's incremental geopolitical disruption risk.
Okay. So it's safe to say that the oil market will provide no shortage of opportunity in the years ahead for private equity investors, but probably an equal amount of risk. So where do you think investors should focus their energy, so to speak, in the years ahead?
Yeah, in the years ahead, I would be getting the mother of all shopping lists ready. As we count the barrels, as we assess recession risk, I think the skew of oil prices is probably lower. And if Russia and Saudi Arabia cannot hold it together and learn to love and cooperate with each other, the price of oil go down to old lows in the $20 a barrel. So if I was private equity, I'd be looking for assets and I'd be expecting to buy them much cheaper in the next year or two. Now, I'd want to hold on to those for 5 to 7 years because we are very skeptical of this peak demand thesis. The folks who believe that oil prices are never going back up to the triple digits, a lot of that view is supported by the idea that we're going to all be in electric vehicles in 10 years. Oil demand's about to peak. It's going to become a stranded asset. Okay, terminal value is zero. I disagree strongly. Our research disagrees strongly. So I would position over the next 5 to 7 years in some of the great sessions today. I'm learning a lot from the private equity folks. I understand that's a time frame they usually think about. I think we're going to have a bust. I think we're going to have lower prices. I think that's going to stress companies, create opportunities. I would get in there. I would disregard the peak demand stuff, and I would position for a boom in out to the 5 to 7 year period.
So lots for investors to consider and think about.
You bet. Buckle up, though. It's going to be volatile.
Thank you for your time.
You're welcome, Phil. Thank you.